Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about put-call parity, interest rates, and many more of the inputs ORATS uses in our put-call parity calculation. Matt, do you want to share your screen and get us started by going over our current positions?
Absolutely. All right, so let's go to positions. We talked about callers last week, and so we did an Nvidia caller around a long stock. So again, a caller is when you have or buy long stock, and then you buy a put to protect, and you sell a call to help pay for that put that you purchase, since they're often very expensive. So we did the let's see, where is that one? We did the January 80-142. I was working with some other things before, so that's the only one that we actually did. And then we purchased the stock at 105. So we actually received a credit for that, for selling the call at 380 over the put that we paid 358 for. So that's another way you could do it. So the January kind was up here. So what has happened, Nvidia now went from 105 to 116. So we've made $1,000, $1,100 on the stock, and we lost a little bit on the risk reversal. Now it's worth 460, not in our favor. So we're down a little bit there. But we may, so we, yeah. So anyway, so we're doing well on that trade. Any questions on that trade, Tyler?
No.
All right,
Glad to see we're continuing to do well.
Yeah. By Nvidia. All right. So yeah, what are we talking about? We're talking about some interesting stuff this week, aren't we?
Yeah. So we wanted to give our viewers a little bit more insight into our options pricing calculation at ORATS, how we use put-call parity, how we use interest rate assumptions, hard to borrowness of a stock, and a lot of those other factors that go into our proprietary calculations.
Cool. All right, so let's find a hard to borrow stock. So we'll go to our stock scanner and we'll say borrow rate. So that implied hard to borrow rate at 30 days, which, so we kind of interpolate, is very high. So we'll put that and we'll see what comes up.
Real quick, Matt, what is the hard to borrow rate? Like, what does that mean?
Right. So what it means is that when you purchase a stock, you have to pay, and you do it on margin, you have to pay interest on that. So you're paying money. If you short a stock, you actually get money. Some brokerages don't do that, but most market makers get money for that. And there's a spread where, it's over Fed funds rate. So it's like, 55 basis points over Fed funds rate you pay, and negative 25 you get. So there's a spread there that the clearing firms make money. However, when there's I should complete that example. So now you've shorted the stock, and then how it physically works when you short a stock is you will, it happens automatically, but in effect, you're saying to your brokerage, hey, can you go find 100 shares for me to borrow, and I'll sell it back at the same price that we borrowed it for. So they have to go what's called stock locate those 100 shares, and usually there's a willing person there to lend them out. So there's a whole desk that does this in brokerages. Now, when a stock gets hard to borrow, then what happens is so many people are borrowing it, they have trouble locating anyone that will lend it to you. And so those are the cases. What happens when a stock is hard to borrow, and we'll just kind of look at some of these. When a stock is hard to borrow, then you will find these interest rates, you will actually have to pay an interest rate rather than receive that kind of negative money that we talked about before. Negative money. Yeah.
So, like what happened with GameStop a while ago or Robinhood, are those similar situations?
Yeah, those were hard to borrow for a while. And we track that with that borrow rate. You could see a graph of that borrow rate. So interestingly, here's Trump Media. So this will be, it's hard to borrow. It's down 3% today in the news, as we've seen. If you go to the trade builder, then you could go to the borrow rate. And you could see that it used to be even harder to borrow, up at 400%, and now it's actually down, but still pretty high. So yeah, you mentioned GameStop. If we were to graph that, it's high as well. And what that means is that people and what happens in the market is people will pay a lot more for puts than calls. So there's a put call parity, and you could go Google put call parity. But what put call parity says is that the strike price plus the call minus the put and stock price with interest in there should be equal, should be zero. Like that's kind of the parity rule is that. Now
It's like a no arbitrage assumption, right?
Exactly.
You can't go on the market and make an arbitrage trade and win every time.
Yeah. And so what happens is in hard to borrow, like most of the time that will hold, but in hard to borrow times, that you'll start to see, well, it's not zero, it's negative something. And so what that means is the hard to borrow rate is below zero. So let's take an example. I always like to do examples. So here's Trump, and we'll go to the options chain. We'll go out 33 days, so about a month, and then we'll look at the 17.5 call. So the mid is 420 and 355. So I'll go to an Excel sheet. 355. So this is the call, or this is the strike, and this is the plus the call. I can't really put it that way because minus the put. Those all should equal zero. Oh, I'm sorry. Oh, minus the stock price. It's a present value of the stock price, but it's a 17. What is this stock? 17.38. So 17.38 is it's a stock price. So if I add all those up, so long. Let's put long with this strike. Oops. That's, by the way, this putting a plus there, that's from old Lotus 123 days. You have to be very old to know that. So if I go, okay, the strike plus the call, plus 355, minus the put, minus stock should be zero. And it's negative 53 cents. That's what this 1685 is the other way. That's how much extra you have to pay to own the put short call, to do the synthetic call. And so at ORATS, what we do is, and here's that month right here. So that is approximately 35% that amount right there, annualized. Actually, I'll have to check that. So you could see that, there's 43, 46, 35%. These are all huge numbers. This should be zero. This is a residual yield. So we calculate this residual yield to line up the calls and the puts. So people might ask us, well, why, in our normal, think or swim or whatever, the calls and puts have much different implied volatilities. Well, they never really should, because what that implies is that, because in this case, the put implied volatility would be much higher than the call, but we know that to be because of the hard to borrowness of it. So we always want to line up the calls and the put implied volatility, because that premium should always be the same. That premium should should always be the same for the calls and puts. If it's different, then you've messed something up either on the dividend, on interest rates, and those are the only things in the put call parity formula that would vary. So you need to figure out, and what we do at ORATS is we just solve for that, what we call the residual yield for each month. And you could tell this is how almost all hard to borrows look. They're high in the beginning and lower as it goes out more, because the traders are assuming that it's not going to be hard to borrow for years. It's just going to be hard to borrow now, especially now with so much going on with the election and everything. Because this is DJG, Donald J. Trump, and so people are shorting this stock and paying for the right to do so when they usually would get paid for that. So does that make sense so far, Ty?
It does. Could it go the opposite direction? Like, are there stocks that are easy to borrow and they have a sort of an offside thing with the calls being mispriced?
There's really no such thing as easy to borrow, because people aren't competing to lend the shares out. They're only going to lend the shares out if they get some money from the brokerage house. And so there's never a too easy to borrow. But what there is a dividend that's off. So oftentimes what you'll see is if the dividend assumptions that you have are off, then that could go negative and show that there would be a dividend that you missed. That's how we find dividends. If we ever miss a dividend date or something, that's how we show them.
Okay, so you're saying all this in the context of calculating a true option price, like what you think you get the closest to the true value of the option.
Well, I mean, I wouldn't put it as a true value. I mean, that although the S&V, our smooth market value, is, I'm just saying that what we say with this is that, hey, in order to line up the calls and puts, in order to explain what is happening in the option pricing formula, it's not a case where the implied volatility of the put is higher than the call. No, it's the case that Trump DJT is very hard to borrow, and if you borrow it, you're going to have to pay, $1 a day or something on it. So it's a very expensive stock to borrow, and that's why the volatilities are different. But when you put the right rates in there, then that lines up the calls and the puts.
Got it.
Yeah. So, it's interesting. It's interesting to think of it that way. So that's the hard to borrow. One of the things I've done too, Tyler. Let me see if I have this up here. Yeah. So another thing that we do every day is we calculate what the actual interest is in the market versus, and then we plot that versus treasuries. So just think about that for a second. So as a matter of fact, I could show it in, I'll show it in like SPY or something. So this is our implied money's endpoint. This is our Excel. And so here are all the expiration times. And if you go on to the treasury.gov, you could find that the interest rates are, are in this kind of contango, or the early days. So these early expirations, these match up pretty well with the treasuries with similar expirations. So we're going to be looking at the 1 year, so 1 year treasury. So it's about this one right here. So today's the 16th of September. Next year is on the 19th. There's an expiration. And at that date, the risk-free rate, so this is the risk-free rate that we present here, is 0.0357. Now, what we do, and we use this in our calculations, unless and we've had to do this sometimes, we will overwrite the risk-free rate if it's materially different from what's in the market. And this is pretty interesting, actually. I did this study where we've charted. So if you look, so the 1 year treasury rate is red. So that's going along there. The ORATS, implied interest rate in the market. So much like we solve for the implied borrow rate, Tyler, we're solving for the actual interest rate. Is it different? And you can see that that's almost always above the treasury. A couple of times it touched, but and that's because of that. You have to pay more to borrow than you get when you short it. That's the reason for this difference here. But what I was looking for was times when this, and so the purple line here is the option rate spread. So that's the spread between what is paid in the market minus the treasury at the time. So that's the purple line here. The SPY price is here in blue, and the Fed funds rate, which is actually what market makers are borrowing against. It's like Fed funds plus 0.55. They borrow, and if they're long stock, and they pay that. And if they're short, then they pay Fed funds minus 0.25 basis points. So that's what they always use in the clearing firms. I know it sounds kind of weird, but it's important to get in the weeds sometimes on these things. You really want to understand what's going on. If you're going to be trading, you want to understand these things, what's going on in the market, how things work. So I think this is really cool to see over time what the implied rate has been compared to the 1 year treasuries, the 1 year implied rates were, and we talked about before, they've been coming down. This is a couple of weeks ago, but when I updated it. But I think it's interesting to watch this spread, because I'm not exactly sure why the spread changes, because other than, there is a supply and demand component, the amount of liquidity out there is pretty good, but it's a year out. And so the best I could come up with is when it gets kind of high like this, it's almost 1% sometimes. That's much more than that Fed funds plus 0.55. So it's 0.55, and it's another 0.5 almost on top of that. And I think it's because whatever's happening in the treasuries is not being corroborated in the implied interest rates for whatever reason. It could be supply and demand of people doing risk reversals, or combos. If you get a really long, if the market makers are really long stock, or that would do it as well. So it's just it's kind of an interesting thing to track over time. And again, I'm unable to really explain it away, other than I've talked to people in clearing firms, I've talked to old market makers, and I haven't got the best satisfactory reason, but those are the best reasons that I've come up with so far. So do you get what I'm getting at here, Tyler?
I mean, it's a lot to take in.
Yeah.
Certainly. I mean, definitely some value in diving into the weeds of the calculation and why each piece matters. I do think I would appreciate to what can this give me in the market? What are some trades that I can do on stocks that are hard to borrow? And what does this sort of mismatch mean to me, and how can I take advantage of it?
Yeah. So, it's interesting. Like sometimes you're out there and when interest rates are changing a lot, especially if the Fed funds changes what they're supposed to do. If you have, if you have a position on that's synthetically short stock, so if you're buying puts and selling calls kind of in your position, and the interest rates change and they go down, they go against you, basically, you're going to lose money. Like money is going to come out of your account. And sometimes it's pretty dramatic. So, you got to kind of be aware of what type of positions that you have on. So, it might be interesting to do that, to put a position on where it makes us synthetically long. If we were going to hedge it, synthetically long stock, because that's how things are priced in the market. So if it's long and you're paying like a 5% interest, and they reduce rates to 4%, guess what? You win. Like you get to pay less, and the options will adjust to reflect that. So again, this might be another collar strategy where and that we could benefit from that type of an arrangement. Does that make sense, Todd?
Yeah, well, that could certainly be an interesting tool to put in ORATs, right? Like, something that analyzes your portfolio and tells you your interest rate risk. And,
Right.
if
Yeah.
you're, vulnerable to interest rate risk, or does it help you? Right.
Yeah. So that's row. We just
Mhm.
don't have it in here right now, but that's a good point. I think, for so long, row hasn't mattered. Interest rate risk hasn't mattered, but I think it might be time to add that column row in there. We do have it, in our API, but we don't have it in here yet. So I don't know if you want to do a DJT. I mean, there's a lot of other things going on there, or another hard to borrow, or what do you think, Tyler?
I think we should do it. Just it's very topical, and I'm curious to see how it's going to work out.
All right.
I
Well,
the only downside I think is that the hard to borrow has actually gone down. Like it used to be way higher. So I'm wondering if that's even should we even consider it if it's down from its average?
yeah. I mean, that's the whole trade. So, to me, it seems like it's actually not that much. How should I say this? It can go higher. Let's just put it that way. Like, even though it's high right now, it's hard to borrow. I think it could go higher. And what you could do. Well, I don't know that I want to get that into it, but like, this is take that month, right? So that October, so at 41%, right? Again, I think that that can go higher. So I would be almost into doing the opposite. Meaning instead of selling those puts that we think that look expensive, I would be kind of a buyer of them. So I would do buy the offer and sell the bid. Is that what I said? No, the opposite. Clear. Let's buy the puts, sell the calls, and buy stock against that, and see if it see if it goes up. What do you think?
Yeah, are you doing that to what we talked about last week, um isolate the thing that makes your trade do the best, sort of minimize the Greek risk?
Yeah, because if you look at the delta here, and I'll turn on my handy dandy.
Yeah, we called it isolating your alpha.
Yeah, isolate your alpha. So in this case, the delta is negative 99. So that's about as close to negative 100. And so if we buy 100, then the only thing that's going to change is if the interest changes. So we're paying that amount like that we saw before. Now it's 73 cents. Where it should be, it should be just the difference between these. It should be 20 cents, but it's 73. So we're paying that extra 50 cents that we saw before. Does that make sense?
Yeah. Does it have any meaning if our SMV is? I mean, our SMV is pretty far below that.
Yeah. Well, the SMV hasn't updated for the hard to borrowness, or that this strike might be, again, different from other strikes. So let's just take a look at it actually. So that's a good point, Tyler. So if you look at this month and you look at, so the SMV is kind of drawing this line through, you can see that purple right there is above. So we want to buy a put. So we want a purple below. So maybe you're right. Maybe we should do the 21s instead of the one that I was doing, because I was doing this.
Well, we did it manually. I mean, one of the best things about our option scanner is that you can rank on this S%, so you can be sure not to do this, right?
Right. But yeah, so that was a good catch, because this one you could see that put, see the purple for put, cyan for call, is above the line. So we don't want to be buying above the line. You want to buy below the line. So which one's below the line the most? It's purple is this one. So we want to.
Why don't you use the option scanner for this and use S% as a weighting?
Yeah. Okay. So let's do the option scanner. Clear.
That's going to look at every combination, right?
Yeah. I'm just afraid that if we do it, the actual market won't, what we talked about before with the S%, if it's too good to be true, it probably is too good to be true, but we just try it anyway. You know what I mean, Tyler? So,
yeah.
So what are we going to do? This is when you, what's it called? When you,
short risk reversal.
Yeah. Short risk reversal. Very good. So that a risk reversal is basically just stock. So they're saying reverse the risk to the options, but a short risk reversal is short stock. So we're essentially going to be doing short stock. So I'm going to make it like a week to, I don't know, 66 days. And what we're going to be looking for, as you say, so we're going to be looking for, but we want this to be a combo. So we want it to be where the the strike width, we want that to be 0, right? So we want it to be, we're just isolating. So we need it to be 17.5, 17.5. And that's what, when you say strike width is 0, so that's what we're looking for. And we want to sort on, see, I'm just afraid that okay, so let's just check this one out. This is a huge S percentage, right?
Mm-hmm.
So it's negative 8 cents at 78 cents. I just don't think you're going to have a chance to get filled there, but
we can also filter on the spread.
Yep, that's true. So let's look at the spread, market width. Yeah, so that's 5% wide.
Yeah,
so
we want maybe 1.5 or 2.
Yeah, let's just make it 1. Okay, so 1% wide, that's 16 cents. 0.17 is 1%. So that's reasonable, right?
Mm-hmm.
Now you can see that the S percentages are down.
Yeah.
So we could weight them all, but yeah. So they want to do the SEP 27s. So let's just. I love doing this. So then you click on the options and you can see which ones are yours.
Yeah.
So if you look here now, like, so they're both kind of under the line, but that's kind of weird because we're buying a slightly higher implied volatility. You see that?
Mm-hmm.
I would have expected to see the put underneath it. I guess it's pretty well lined up is what we're finding, right?
Yeah. And then we put a max on the market with the percent.
Right. All right. So now it's this one. Now it's the 18 column put. Let's just take another quick look at it. So the call's slightly higher. So I like that one. Let's do the 18. All right. So let's do this trade, Tyler.
Cool.
88 cents, 90. So we're already paying a little bit above. We'll pay 92. Force it. And at the same time, we will buy 100 shares. And we wait. Oh, we need to up it a little bit. Usually you should probably do the stock first. All right, we're in, Tyler.
All right, excited to see how this one turns out.
Yeah, let's we don't want any funny business out there, so hopefully everyone's safe. But let's take a picture of it for next week. All right, so it's a pretty good show. And there's so many things in the option market to think about, and hopefully we're bringing them to our audience and educating everybody.
Yeah, thank you, Matt. Very informative as always. You can look in ORATS University has we touch on every part of the option price calculation briefly. There's a lot in there, but sort of at a glance. So thank you, Matt, for diving into it a little bit deeper here. But if you want a more general overview, you can always check out ORATS University.
Yep.
If you guys have any specific questions, please reach out to us at support@orats.com, or you can leave a comment on the YouTube video. Well, thank you, Matt, and thank you, Trader, for hosting us again, and we'll see you guys next week.
Thanks, Tyler.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.